Hi, Reza here. So you've chosen a limited company as your preferred structure to hold your property investments. And a question I get asked by most property owners who run their business through a limited company is, how can I draw out the profit in the most tax efficient way? Well, there are many ways, four in fact, that I'll go through today on how you can draw out the profit from your property company tax efficiently. The first one is salary. You can take a salary from your property company, and the implications of that is that you've got to run a payroll. And every month you would run the payroll, you would declare how much tax is due on the amount of salary that you wish to take and pay that across to HMRC. So there's an additional administrative burden involved. With payroll, of course, you are subject to tax at your highest marginal rate. So if you are taking over and above the personal allowance, which is around about £12,500 currently, you're taxed at 20% up until the basic rate, which is £50,000 currently. And thereafter, you're taxed at 40%. Up to £100,000 of income. From £100,000 to £120,000, you are subject to a marginal rate of 60%, and thereafter 45%. Remember, on salary, you're also subject to national insurance. So national insurance gets paid by the employer, i.e. your property company, at 13.8% of the salary paid. Every month there is a cash flow drain. So salary is not really the most common way of taking out cash in the most tax efficient way, even though it is deductible for corporation tax. However, a small salary up until the personal allowance bracket or up until the national insurance bracket is quite advantageous because it gives you a corporation tax deduction, so you're saving corporation tax, and also gets you out some tax-free cash if you don't have a salary from any other company or position. The second route to draw out money from your company is via dividend. And a dividend is probably the most tax efficient way to draw your profits from the company. The reason being is that the first £2,000 is tax-free. It used to be £5,000, and before that actually it used to be anything up to the basic rate was tax-free. But that's changed in recent times as small business owners have had a knock on the taxes payable by the government. But in your basic rate band, the tax rate for dividends is just 7.5%. Bear in mind, however, that this profit has already been subject to corporation tax. So the company pays corporation tax on its profit. Let's say £100,000 is your profit. The company pays corporation tax at its rate of 19%, 19,000. The balance, 81,000 of profit after tax, is available to draw as a dividend. And that's the amount on which you would pay income tax, either at 7.5% in the basic rate up to 50,000. Thereafter it rises to 32.5%. up until 150,000, and thereafter rises to 38.1% over and above £150,000 of dividends. Now, another advantage of dividends is that it can be spread across different shareholders. So if you have multiple shareholders in the company, you can share the dividends out between multiple people, thereby utilising multiple tax bands and allowances, which can be quite advantageous because everyone can use whatever allowances they still have available. So moving on to the third option, and the third option is to take interest from the company. Now you may ask, well, how do I take interest? Well, you can only really take interest if you've actually made a loan to the company. Now, most people would have to make a loan initially because they would set up a company, and in order to actually fund a property purchase, they've got to put the deposit funds in as a loan, a director's loan from themselves personally to the company, which the company can then use to put down as a deposit against a purchase with the aid of a mortgage. So you could pay yourself interest on your director's loan. And the benefit of that is the first £1,000 is tax-free. Again, if there are more of you in the business as shareholders, you can each take £1,000 if you have lent monies to the company. And thereafter, it's taxed similar to salary in terms of the tax bracket. So first £12,500 tax-free personal allowance, then 20%, then 40%. However, the benefit of paying interest over and above salary is that there's no national insurance on interest. So you don't have to pay that across. And also, interest is corporation tax deductible. So like salary, you get a corporation tax break from paying interest. There is an additional administrative burden involved, however, where a company pays interest to an individual, it has to file quarterly returns to HMRC known as CT61. So bear in mind that that will need to be done. And the final option is to pay yourself a pension or pay into a pension from the profits of the company. Now, you perhaps don't need the income from the company that's accruing, but you could do with topping up your pension, for example, if you might be approaching retirement age. The company can make a contribution on your behalf as a director to a pension, which the company gets corporation tax benefit on. For example, if it makes a £10,000 contribution into your pension scheme, then the company benefits by being able to offset that against its profits and thereby get corporation tax relief, which at the current rates would be £1,900 reduction of its corporation tax bill. There are allowances and maximums of pension contributions, but generally, if you're not a top rate taxpayer, so if your income is not £150,000 or more, then the company can make potentially a contribution of up to £40,000 per director into a pension on your behalf. I hope that was useful and gives an overview of the ways that you can extract money from your company in a tax efficient way. For more information, go to www.allaboutpropertytax.com, where you can download a free copy of my ebook. Bye for now.